Forward Guidance is brought to you by VanEck, a global leader in asset management since 1955. You'll be hearing more about VanEck ETFs later on, but for now, let's get into today's interview. Happy to welcome to Forward Guidance Andrzej Skiba, Managing Director and Head of U.S. Fixed Income, as well as Senior Portfolio Manager with RBC Global Asset Management. Andrzej, welcome to Forward Guidance. How are you doing?
Hello, Jack. Thank you for having me. Well, I'm surviving a snowstorm here in Connecticut, so it's quite an eventful day, but managed to make my way to the office to have a conversation with you.
I'm glad you did, Andrzej. All the work you do with the fixed income team, so that's bonds, loans, all sorts of fixed income products. But I want to ask you about a world that maybe used to be a niche, but now is definitely becoming larger and larger, and that is the world of private credit. So, what is private credit, and how would you characterize its rise over the past few years?
Yes, that's been the fastest growing part of fixed income markets over the recent years. So, private credit essentially is provision of debt, is lending to companies outside of the public markets. So we're not talking about corporate bonds, we're not talking about broadly syndicated loans. We're talking about a situation where a company makes an agreement with one or two lenders to borrow money. And this space has grown tremendously. The origins of the private credit space take quite a few years from where we are now. And a lot of the beginnings were driven by regulators, essentially forcing banks to offload exposures to smaller, less diversified companies with a lot of debt on their books. In the markets, always you have innovation. So into that void step in investors who started providing direct lending to these institutions. So today, when we're talking about private debt, that space includes a whole variety of investment styles. There are investors looking at infrastructure assets. You have distressed investors, but also one of the spaces that has been growing probably the fastest in recent years has been direct lending. So that is the space that garners a lot of attention right now, where investors are drawn to potentially juicy returns. But in our opinion, that does not come without risks.
Why have they been drawn so much to private credit, and what are the risks that you just referenced?
Well, the main attraction of the space is double digit returns. So the asset class has done well in recent years. And bearing in mind that we've only really started growing, particularly in the context of direct lending in the last 5, 10 years, it's a pretty new asset class. So initially, you are getting quite a lot of really good assets at really attractive valuations for debt investors, generating those double digit returns. That clearly is the appeal, that the returns of this asset class were definitely greater than what you could obtain in public markets. If you think about it, a few years ago, when rates were much lower, it was very difficult to get any kind of return within fixed income. So to garner double digit type returns, still being within fixed income, seemed quite attractive. The other appeal of the asset class was to do with lack of mark to market accounting. So when, as an investor in a public bond securities, I look at my portfolio, at the end of the day, I need to price those securities and provide my investors with an update of how the portfolio is doing. You have price transparency, so you can see whether the market has gone up or down in a relatively short space of time. Well, here you have no mark to market. You are shielded from market price fluctuations. And the only times you need to make any adjustments to your valuation is either when the security is repaid or if you have to write down the value of that security. But so far, as economic growth has been pretty robust, that has not happened. So for investors, this combination of lack of mark to market and juicy returns was difficult to ignore.
That makes sense. So if there's a little bit of a credit event and credit spreads widen significantly, as they did close to a year ago in March, when Silicon Valley Bank fell, if you hold a high yield bond or something publicly traded, that will decline in value. That has to be reflected on your portfolio. But for private credit, you can just say, "Oh, I bought this for $100. It's at $100. It's $100 bond. That's what it is."
Spot on. And that's why we had bizarre situations where, for example, I would go to speak at an investor conference across the US, and you would have a panel of investors from across the fixed income industry speaking about their outlook for the markets. And you would have comments like, well, the economic growth is uncertain. I would prefer to stay away from public high yield markets, but I think that private credit is a safe space to hide, which, in our opinion, was borderline insane. But that lack of mark to market was giving people this false sense of security that since the price is not changing at all, then there's nothing wrong happening with my investment.
Explain, why is it insane for someone to say, "Oh, things are risky. High yield is too risky. I'm going to go into private credit." What is so wrong about that in your view?
Well, if you think about what asset class we're talking about, it's leverage finance. It's higher risk debt investment. So, by definition, we're not talking about government bond securities or investment grade rated credit. So, from the get go, the level of risk is higher than otherwise would be the case. But also, the other thing that we need to remember is how this asset class started. So, with banks no longer being able to lend to smaller, less diversified companies, well, those were embraced by investors within private debt space and direct lending in particular. So when you're looking at those businesses, you tend to look at smaller, weaker companies compared to those in the public markets that tend to be larger, more able to withstand economic pressures. There's a reason why many of these companies did not have access to public funding. Like arguably, it's cheaper to issue debt in public markets. So if you had none of that access, well, then there's something about you that is riskier than public investors can accept. So from our perspective, when you're looking into a slowdown scenario, it's really misguided to expect that these less diversified, smaller companies that have fewer avenues to deal with an economic slowdown would be somehow doing better than their counterparts in the public market. The other reason why we felt that this characterization really is not close to the truth is the fact that in this higher interest rate environment, in a world where rates are high, particularly companies that are paying debt that is linked to floating debt, i.e., your coupon is not fixed. So you take whether it was LIBOR or SOFR rate plus a margin, a spread. Those companies were most under pressure in recent times. So if, for example, we compare the case of the US high yield bond market, well, vast majority of companies was super proactive in 2020 and 2021 issuing debt. You even had some triple C rated companies, which is as low as it gets within high yield before a default, issuing debt with a coupon that started with a number 5. Well, these
Wow.
days, that's almost treasury yields. So companies have been super proactive in refinancing their debt. And what it meant is that when rates did increase, when Fed hiked rates aggressively over the recent years, they weren't that bothered. They weren't bothered because they already termed out their debt. They didn't have to come to the market and lock in these higher costs of funding. Well, if you are leveraged loan or private credit company, well, then the situation is very different because with every rate hike, your cost of funding has increased. So right now, when we're looking at an average that these companies are paying in terms of their debt costs, well, we're talking about low teens in percent terms. And that is a big deal because when you think about the amount of debt that these companies have on their balance sheets, excluding add backs, industry data is suggesting 6 to 7 times annual profits in terms of the amount of debt that they're carrying on their balance sheets. Well, when you're paying low teens in your cost of funding, and you multiply that by this kind of leverage, you end up in a situation where um, 3/4 of your cash flow could go out of the door straight away just to pay your debt. And that is a problem because that means you have very little money left to pay for your capex, for capital expenditure, to deal with your working capital needs, to maybe pay some taxes if you need to. So, a vast majority of private debt companies, right at this moment, is being strangled by this high cost of debt and is barely generating any cash flow. So, especially at a time of economic uncertainty when a slowdown could well be on the cards, that creates an issue. That is a problem. That makes this space particularly vulnerable compared to public markets where companies are just laughing at the fact that they managed to get cost of debt at 3, 4, 5% range and now don't have to access markets.
So people talking about a 15% yield on a private credit loan, that is very juicy for the investor, but as you say, that comes with risk. And you're saying if these loans are to entities and companies, smaller companies that have they're leveraged 6 to 7 times, nearly all of their operating cash flow is going to pay off that debt. Is that just a handful of companies or is that widespread?
It's pretty widespread because when you're looking at the average margin, the average spread they're paying over the floating rate, whether that's again LIBOR or SOFR, whatever is used these days, that is a standard across the industry. Actually, you can argue that some of the recent transactions where there was a lot of competition to get these deals priced are having slightly smaller margins, but even they are paying double-digit costs of funding. So this issue is pretty widespread across the whole space. And that's why our concern relates to the fact that, look, if you had one or two or three companies facing these issues, well, then you would expect that private equity sponsors, because those are the ones who are mainly the owners of companies accessing private credit and direct lending in particular space, that they would throw some money at the problem, help them to kick the can down the road and improve their financial stability for as long as rates remain high, give them a bit of a lifeline. But if you're looking across your whole portfolio and vast majority of your companies is paying these exorbitant costs of debt and is not generating much cash flow, well, then the problem becomes more acute because if this situation continues, do you really have the willingness and the ability to help everyone out? And that's when problems start.
Very interesting. A lot of these companies are owned by private equity companies. So private credit funds are funding companies that are owned by private equity. Can you just explain that point that you made a little bit in greater detail?
Yes, that's correct, Jack. So um, at the end of the day, a company that is run in a particularly conservative fashion doesn't have the need to run with 6, 7 times leverage. So that has been achieved for the purpose of improving equity returns of equity owners. And that's why when we're looking at the destination of travel for vast majority of floating debt in recent years, whether that's leverage loan space or whether that's private credit space, that's been LBO deals where private equity was choosing these markets to finance obligation in either leverage loan or private credit space rather than coming to public high yield markets, where generally issuers are more conservative, where the willingness of investors to accept rosy profit projections is also much more limited. I mentioned earlier that we're looking at the leverage within this space, excluding add backs. Well, what are add backs? Add backs are all the items that haven't happened yet, all the items that are not really cash items that owners add to the profitability of these businesses when they're marketing these transactions. So it could be a contract you haven't won yet. It could be a synergy from M&A transaction that hasn't been realized yet. It could be a lot of goodies that look good on paper, but are not real hard cash yet. So while there are legitimate add backs that you want to consider, well, if you close the transaction mid-year to acquire a business, looking at pro forma numbers that include full year of that business makes sense for like comparison. But a lot of those add backs are much more aggressive, and they're hoping for outcomes that may or may not materialize. So when you're looking at leverage excluding those add backs, it's really high. And bond markets traditionally scoffed at the idea of accepting aggressive add backs in a way that the leverage loan or private credit space has accepted. So that's another reason why, as a destination of travel for funding more aggressive transactions, those were not going to the public bond space, they were going to the leverage loan and the private credit spaces.
Andrzej, where do you think we are in the credit cycle? I want to know your thoughts on that, but also whether if we have a benign cycle, maybe private credit continues to do well, but if defaults start to pick up, how do you sort of see this playing out? Is there, by the way, a back test? Like what was the private credit industry like in 2006, 7, and 8, and how did that fare?
Well, we don't really have much evidence regarding that because vast majority of the growth within the space happened after the global financial crisis. And even when we went through pretty testy times during the COVID pandemic, that disruption was relatively quick. And also, rate cuts that ensued lowered the cost of funding dramatically for issuers. So it made a lot of sense why many of the companies that would hit a speed bump would get a helping hand from the owners to get through that period of turbulence. So it's really not been tested in terms of a broad, longer slowdown, maybe even a recession. And that's what needs to be taken into account. Like from our perspective, we don't have any dogmatic issues with the space. All we're saying is that investors who are allocating capital to that part of the fixed income markets need to be careful and understand that this yield on offer does not come for free. There is a risk attached to that. And as you mentioned, there are economic scenarios where everything plays out fine. And there are economic scenarios where it becomes more difficult. So a more benign scenario, of course, would be Federal Reserve cutting rates quite aggressively while US economy still growing, not falling into a recession. Like that is what each of the private equity sponsors and each of the investors in the debt of the securities of these companies is hoping to experience, that we would go through this relatively short period of low cash flows, but things would look much brighter on the other side of the horizon. But that is one scenario. Another scenario where inflation remains sticky, where Federal Reserve cannot cut rates nowhere near as aggressively as investors are hoping, while at the same time the economy is slowing down, so almost your stagflation type environment, well, that would be very problematic for these kind of issuers because if your starting point was very limited cash flow, and then on top of that, you would get hits to your ongoing profitability, you would be under pressure on multiple fronts, and then the outcomes could be much less palatable. So there are clearly scenarios where this space will do fine and investors will be rewarded for the investments they made in those securities. However, a lot of things have to work out well. A lot of things have to align for that to be the case. And our view is simply that whether you're looking at broadly syndicated loan market or whether you're looking at a public bond space, on a risk-adjusted basis, we'd actually prefer those more liquid markets where you can reposition if you want to, rather than being stuck in a security facing the uncertainty ahead.
You said stuck with the security. Does that mean that if you wanted to sell a private credit loan, I mean, how would you go about that? Is that more difficult?
It's a bilateral agreement, so you're kind of stuck. If anything goes wrong, it's between the owner of the company and yourself, and maybe you have another partner that participated in these loans. So in a way, what was part of the appeal of the asset class for direct lending, where you had these bilateral agreements, you could craft your own documents and make sure that you had as good a protection as possible in any negative scenario. Well, the downside associated with that is when trouble hits, you're kind of on your own. And unless your private equity sponsor or whoever owns that company throws you a lifeline, you need to deal with the balance sheet of the company if it were to go through restructuring. Unlike in the public markets, where you have a wide variety of investors who could come with a lifeline and hope to fix whatever is broken within the business. So that's the story as old as time. The less liquidity you have, the more customized agreements you have, the more return, but also risks go up alongside that.
And tell us about the debt covenants, basically power given to the lenders to say, oh, you can't go over this amount of debt threshold to make sure that things don't go out of control. I think a frequent criticism maybe of the leveraged loan market is that a lot of those loans were covenant light loans. And one positive thing that people in the private credit community, I think, say is we actually have much stronger covenants. We can exercise control of the companies to make sure that our capital is protected. What are your thoughts on that argument?
That is true. And at the outset of the asset class, you clearly had superior documentation afforded to lenders within the private credit space. But in the same way as in the broadly syndicated loan market, with the advent of all these cov-lite deals, the standards have fallen a lot. In the same way, those standards are falling within direct lending space too. It always happens when a wall of money is hitting an asset class, whether that's equities, whether that's fixed income, crypto, you name it. Standards do fall as more and more money is chasing fewer and fewer opportunities. And here, what we have seen over the recent years is not only weakening of protections afforded within the direct lending documentation, but also lowering of extra compensation you are getting for investing within the asset class. If you're looking at the current yield that you're getting, the current return that you're being promised within the space, it's less than 200 basis points ahead of single B rated leverage loans. So that has shrunk a lot over the recent years as more and more money was competing within the space. Managers are very keen to invest the funds they raised over the recent years within the space, and that is leading to weaker documentation and weaker extra compensation on offer. So yes, the documents are probably better, but when the trouble hits, at the end of the day, it's equally important how can you resolve that, whether you're on your own or whether you can go to a broader group of investors and look for solutions. And that's also worth something, in our opinion.
So the risk of a lot of the deals is higher, and the credit spread, the risk, the reward is a little bit lower. Tell us about this wall of money that is coming to finance private credit. Where is that wall of money coming, and is there a particular catalyst for why this is the case? For example, if we were to wind the clock back 3 years and you would just say, interest rates are going to go up so much, I would think that would maybe actually cause money to flow out of the riskier segment and into the risk-free segment, like the treasury market or the investment grade market, not risk-free, but much lower risk. Yet maybe it seems like the opposite has happened. Do you have a theory or a reason as to why that might be?
There are a couple of reasons for that. The first one is that promise of no mark to market. The fact that you have no headache on a daily basis, you make your investments, you believe that you have selected good managers that will avoid the bad eggs and will do a lot of due diligence when selecting companies. And without any shadow of doubt, like surely there are better and weaker managers out there. The story is all this time. So that gave people a lot of comfort that with the belief that with the right manager, the right credits being selected within those private credit portfolios, and no mark to market, it's a match made in heaven. We have seen private credit attract more than $200 billion per annum in recent years. Like, those are staggering numbers. And as I mentioned earlier in our conversation, some of that does not relate to direct lending. It could be other perfectly legitimate uses like infrastructure investing or distressed investing, but an increasing share of that money flow related to direct lending. In recent years, around a half of the inflows were in that space. And in a way, that was the missing link for investors within more traditional high yield space. Because when you're looking after the traumatic events of 2022, when not only stocks had a horrible time, but also fixed income had a horrible time, and people were shocked with double digit negative declines within fixed income. Well, half of the money came back in 2023 when it comes to investment grade. So, as you rightly pointed out, people wanted to get back into the space and take advantage of more attractive valuations. But when you're looking at the high yield space, none of the money came back. You had outflows that were not followed by any meaningful inflows, and that continues to be the case. Where all the money has gone into has been private debt. And that has been by far the biggest area of demand for investors with a greater risk tolerance in our universe.
Like gold did, Bitcoin is establishing itself as a macro asset that potentially helps hedge against the government devaluation of your money. Finally, you can easily access Bitcoin in a low-cost ETF with the VanEck Bitcoin Trust, ticker HODL. Search the ticker HODL in your brokerage app today. Visit vaneck.com/HODLFG to learn more. That's vaneck.com/HODLFG. Now the disclosures. Investing involves risk and you could lose money on an investment in the VanEck Bitcoin Trust, also known as the Trust or HODL. The value of Bitcoin and therefore the value of the Trust shares could decline rapidly, including to zero. You could lose your entire principal investment. For a more complete discussion of the risk factors relative to the trust, carefully read the prospectus link below. Thanks, let's get back to the interview.
And what is the interplay between private credit and the rest of the fixed income universe? There's investment grade corporate bonds, high yield bonds, collateralized loan obligations, other products. Are those sort of two separate spheres, and the two ships going in the night, and they never meet? Where do they intersect? Like, are private credit loans ever sold to other institutional investors? Are high yield bonds ever refinanced by private credit?
No one exists in a vacuum. And indeed, there is a broad impact across the whole fixed income universe through generally macro events. So, where we are in the business cycle impacts all kinds of companies, no matter how strong your balance sheet or not. But on a day to day basis, the biggest tug of war that we are seeing is between the broadly syndicated leveraged loan space and private credit. And here you have this curious case where leveraged loan space has been growing for years. It has actually outgrown the traditional high yield bond market, fueled by a lot of activity in the CLO space. And leveraged loan space hit around 1.5 trillion in size. And that used to be the primary destination of more aggressive transactions, as we spoke about earlier. Private equity sponsors like the fact that with a shorter duration capital structure and a floating capital structure, it affords you more flexibility. They like the fact that the market was accepting of more aggressive ad backs. So that used to be the destination of travel for LBOs, for dividend recaps. And in recent years, as money started flowing aggressively into the private credit space, you suddenly have this situation where money needs to find a home. And suddenly, private credit was refinancing a lot of obligations within broadly syndicated leverage loan space. So last year, for the first time in ages, leverage loan space actually shrunk in size. High yield bond market has been shrinking for quite some time as issuers chose to be quite conservative and, as we mentioned earlier, managed to issue all the debt when they needed to a few years ago and had no need to come to the market. But the one that kept growing, fueled by CLO growth, was leveraged loan space. And now, last year, for the first time, that space actually shrunk because all this money poured into private credit space meant that this space was stealing deals from the leverage loan space, and those were being refinanced in private credit market, or the LBO transactions were going straight into private credit market rather than leverage loan space. And this had both upsides and downsides. Like, the downside is the fact that there's less activity, but the upside was the fact that for some of the hairier stories, for some of the names that were more problematic from public market perspective to refinance, they were finding a home in the private credit space. So that allowed to avoid defaults, that allowed to help smooth the credit cycle. And in that respect was definitely positive for leverage loan investors, where they were worried, will I be repaid on my loan? And here comes the cavalry. This year, what we're seeing a lot is this tit for tat between the two markets competing for attention, where we have pretty active CLO pipeline, so demand for new paper within leverage loan space, but also money keeps pouring in into private credit space, and those investors are really willing and ready to step into a lot of credit opportunities and snatch deals away from the leverage loan space into private credit. So we're seeing that tit for tat pretty much on a daily basis now.
Wow. And what about between the leverage loan market and the high yield bond market?
Those do speak to each other quite a bit, but generally you have a situation where companies that have both bonds and loans within the capital structure continue to do that. And when there are periods when the leverage loan space is struggling with absorbing the amount of deal flow, then yes, you can see some opportunity for issuers coming with senior secured bonds into the high yield bond market and redirecting some of that pipeline into the high yield bond space. But generally, we see the high yield bond market continues to be mainly refinancing market. It is less a destination for new financings, for new transactions, whether that's M&A or dividend distributions, and those are happening predominantly within the leverage loan and private credit spaces. So it's an important part of the leverage finance framework, but we're not seeing a massive shift of investors from leverage loan to the public high yield bond market or vice versa.
Thank you. So a lot of new origination is happening in the leverage loan market or in private credit, high yield bond market, mostly refinancing. I just want to highlight and make sure I got it right that you said a lot of private credit deals are used to finance, you said LBO, so leverage buyout, that's private equity, and then dividend recapitalization. Is that when basically private equity investors pay themselves a dividend by borrowing money, kind of? Because,
Exactly.
when Apple pays a dividend, it's paying it from its profits.
And here, this is paid from debt. So the easiest way to imagine that is, let's imagine a company that initially offered their securities when the leverage was 6 times. They've done well, they deleveraged to 4 times, and rather than staying there, they're paying themselves a distribution to go all the way back to 6 times. And this way, the private equity sponsor is repaying some of the equity check that they provided in the initial transaction, boosting their returns. So we're seeing quite a few of those distributions happening at this stage. And one of the drivers of the market accepting that, because it's less common within the bond space, is the fact that we had an absolute wave of repricings within the leverage loan space, where issuers are more confident about the economic outlook and more cheered up in terms of the prospect for rate cuts, have decided that they could lock in lower cost of funding by renegotiating with lenders the margin, the spread that they pay on their loan obligations. Well, that is all typical for the space. However, the volume of that was quite overwhelming, and it's not the preferred activity, as you can imagine, that CLO investors see, because the returns are getting diminished. What they were craving is more new investment opportunities to put money to work in the context of new CLOs that would be originating, new warehouses where they're investing. And that's why, with better economic outlook, the idea of being accepting towards dividend distributions gained more traction. And we're seeing quite a variety of transactions where you have those distributions funded by first lien secured loans within a variety of issuers. In the high yield bond market, it tends to be much more seldom that we see this kind of activity.
And how does the rise of private credit affect your outlook on the leveraged loan market or on the high yield bond market? Does it make it less risky, at least when the financing and refinancing is occurring? And I'll explain what I mean. That, let's say, the high yield bond market, if defaults would be at 3% if there was no private credit, but a third of all the deals that would default are refinanced and taken out of the high yield bond market and put into private credit. So the actual default rate is only 2%. And that, even though it may not end up well down the line, for in the short term, the high yield spread should be lower, and so that's that, kind of net bullish. Does that make sense?
Yes, I think you're spot on, Jack. So if you are forecasting a relatively benign period ahead when just a few companies have issues, something that is pretty typical, that one or two, three credits have a problem. In that world, having the ability to get funding in the private credit space is really helpful, because that's another avenue how you can avoid a default, how you can repay these obligations. But as we discussed earlier, the issue here is not that you have a few bad apples, is that currently you have a whole space where there's barely any cash flow generation because they're suffocating under the weight of debt, the cost of debt that they have to service at this time in the rate cycle. So this is the challenge that you're facing, where when problems are seldom, any optionality, any other pockets of the market where you can address those issues are always welcome. But if here you have more of a broader issue where if rates stay high and economy continues to slow down, and suddenly a lot of these companies start to struggle in a more visible fashion, that then becomes a broader problem, something that both the regulators and a broader set of investors will have to grapple with. Because if you have an increase in a wave of restructurings within private credit, that will have implications for broader demand for leverage finance securities. That will have implications for amount of capital that can be committed in other parts of the market, as this space is struggling to deal with its problems. So all really hangs on whether you have a broad set of problems that needs to be addressed, at which point it is an issue and it's something that will make investors lose sleep, not just within private credit, but will have ramifications outside of the space, or whether those are isolated incidents.
And what are you seeing in the high yield market right now? I just have one index in front of me that says the high yield spread is 3.35%. So 335 basis points over the risk-free rate of treasuries. Back the envelope math here, would that mean that maybe, like, if only 3.3% of companies defaulted, you'd break even? Now, obviously, relative to treasuries, obviously you want to do more and you should pay for that risk. But where are what's the default rate now in the high yield market, however you define it? And where do you and reasonable people have a sense of where that might be headed?
Based on our data here at Blue Bay, we are seeing default rates in the public markets in low single digits, and default rates within the leverage loan and private credit space more in low mid single digits. That is actually already quite unusual, because historically the extra protection that you were afforded within the loan market or private credit space meant lower defaults than you would see in the public high yield space. But for many reasons that we discussed on this call, it is the reverse now, and it's likely to remain so, given the risk profile of the leverage loan and especially direct lending spaces is much greater. So, going forward, we believe that for high yield bond issuers, default outlook is pretty benign. And the main reason for that is there's kind of no maturities left for this year. we have the smallest maturity wall in the high yield bond space that we had in a very, very long period of time, like tiny fraction of the market. So maturities are only starting to kick in around midpoint of 2025. So if rates do not come down, if financing conditions remain difficult, that would start becoming an issue as we traverse through the year and companies are starting to deal with their current liabilities, those that are less than 1 year to maturity. But generally speaking, right now, people are pretty relaxed within high yield. It also helps that companies in the public high yield bond space have used all the cash flows, all the extra cash flows obtained in a post-COVID world, not to spend on share buybacks or aggressive M&A, but actually to strengthen the balance sheet. So we have close to the lowest leverage since global financial crisis within the public high yield space. We're talking about less than 4 times. So when you compare that to, close to 6, 7 times in the private credit space and maybe around 6 times, excluding add backs, in leverage loan space, that's quite a stark difference between the two. So we are pretty relaxed here at Blue Bay in terms of the default outlook for the space. However, we also recognize that that presumes the economy slows down but doesn't fall into any meaningful recession. That's our base case scenario. And we also assume that gradually Federal Reserve can cut rates. But when it comes to private credit and leveraged loan spaces, you could easily point a scenario where, especially if the stagflation narrative gains more traction, where default outlook could lead you to double-digit defaults within those portfolios. At the end of the day, if you don't generate much cash flow and you're already highly levered and your ability to refinance will be more limited in this market, well, that's how trouble happens within leverage finance. So look, there are definitely more benign outcomes that could well happen. As I mentioned, if rate cuts are aggressive and economy slows down but doesn't do anything more ominous, that could be enough of support to steer through that for the space. But there is a pretty stark difference in the relative strength of the public high yield bond space and other parts of the market, which explains why the spreads within high yield bond space are not super exciting. So like from our perspective, some of the highest quality high yield issuers within the public high yield space, we really struggle to get excited about them here at Blue Bay. Like we feel that the trading at very small pickup compared to investment grade opportunities, and we just want to be paid more for risk. So we think it's a great time if you're an active investor where you look at the market and decide which are haves and which are have-nots, but stay away from kind of generic spread opportunities because those do not leave much on the table.
So what are you excited about at Blue Bay?
Well, there's a lot of interesting stuff happening in the macro space. So I think this is a year when getting right calls in terms of direction of rates, in terms of what Federal Reserve will do, how economy will progress, could easily lead to double-digit returns in your fixed income portfolios. So we generally advise our clients gradually to move further out the duration, gradually to move away from like money market investments and those very safe but capped essentially returns, and be a bit more brave and go further out the duration curve within credit or securitized spaces. And as rate cuts do happen, and we can talk about that in a second, we do believe that a lot of money that still has not returned to the asset class will be put to work, both in terms of US domestic demand and also international offshore demand for public US fixed income. At the end of the day, if you can create pretty reasonable scenarios when you get to 10% type returns both within investment grade and high yield over the coming 12 months. On a risk-adjusted basis, that is an opportunity that many investors would not want to miss. But in our opinion, you might want to wait for a bit more clarity in terms of inflation data cooperating and the path of Fed policy to really pull the trigger. Because right now we're in a little bit of a limbo as data is not as supportive as it was even a few months ago, and you have very heavy treasury issuance ahead of us as US government is trying to fund its ballooning deficit.
Thank you. So where on the US Treasury curve are you most excited about? Is it in the 2-year space or further out? Or
So look, we're not far from a point where when you're looking at 5 or 10-year treasuries, those start becoming really interesting. We're looking at how much the market is pricing in terms of the rate cuts, and that has moderated a lot. So, we were quite skeptical at the outset of the year when the market was pricing in 150 basis points of rate cuts and starting already in March. We were back then telling all of our clients that this is too optimistic, too good to be true, and the rate cuts are likely to happen around the mid-year point and less than 150 that was priced in. Well, all it took is some stronger labor data and like today's elevated inflation print, and suddenly we are pricing in less than 100 basis points of cuts this year, and the first cut happening in June rather than March earlier in the year. So from our perspective, you're actually getting to a point where if you're looking at your US aggregate, like core plus type investments within the US, if you choose an active manager that can navigate the space well and pick the attractive corners and avoid the ones that don't leave much upside on the table, this is really becoming more attractive. And especially if you hit 450 on the 10-year treasury, I think there will be a clamoring of clients trying to lock that yield, especially since a lot of investors felt they missed the party towards the back end of the year when we had this enormous rally within fixed income to levels which we felt were a bit too quickly too far, but now are becoming more rational. So we generally suggest to investors, depending on the risk tolerance, getting invested within either investment grade or high yield spaces. And the difference between the two is such that in high yield, you are more likely to see that double-digit return, because in high yield, your starting yield is already quite elevated. So all it takes is a little bit of a rally within the space, avoiding defaults and just picking, the more interesting corners of the market to generate that 10% return. Whereas in investment grade, a few more things need to cooperate. So rates need to rally. Let's say 10-year treasuries need to go to 4% or less, and similar kind of shifts across the curve. You need spreads to move 10, 15 tighter, which are not egregious demands, but more things have to cooperate to get to that 10% return from your starting point of a slightly lower yield than you have in high yield. But a lot of investors would still take that because the argument is on the risk adjusted basis, getting 10-year treasuries around 4% in the next 12 months and having spreads a little bit tighter is not a big ask. So actually, even though this outcome is less certain than within high yield returns, I'm happy to take that as we look ahead. So we're having a ton of debates here, as you can imagine, here at Blue Bay with our clients and prospects about how to deploy capital, when to do it, and when to feel that data is evidencing that the trend for rate cuts is well entrenched, because after the last few prints, the bond bulls are getting a bit concerned that the narrative is changing.
They are indeed. And so 4.5% that you said, that's a level in the 10-year where you think some people could get excited to go on the long side. Do you have a view on sort of a long-term steady state neutral rate on the 10-year in order to like build out a yield curve? In other words, we can talk about, is the first cut interest rate cut by the Fed going to be in May or in June? But I guess you have a view on the terminal rate, like where is the lowest possible the Fed cuts to? And basically, if during the 2010s the pretty standard curve was short end at 0 and the long end a lot higher than that, how do you envision a normal looking curve, an upward sloping uninverted curve looking like? And then we'll get into how do you think we get there?
I think this is by far the most important question that fixed income markets are facing ahead, and broadly, risk investors should focus on, because there's a world of a difference if we get a few rate cuts this year and then Fed stops, compared to a world when they cut this year and continue cutting quite aggressively throughout 25 and beyond, because they are so much above the neutral rate. And there's been a lot of academic debate about where the neutral rate should really be. And while historically and for now it's still the case in official projections of the Fed, that level of rate starts with a 2. A lot of economists, a lot of market participants are questioning whether that is still the case. And they're pointing to the fact that, well, if the neutral rate was that low, how come is it that after hiking as much as Federal Reserve did, economy seems to be doing pretty fine and can live with that higher level of interest rates? So they are arguing that, well, maybe the neutral level starts with a 3, if not higher. So it will be fascinating to watch as the answer to this question unfolds. Are we just going to get a few rate cuts and then we stop because inflation kind of settles around 3% levels and just refuses to cooperate further, and Federal Reserve rethinks what should be that terminal rate within this cycle? The proponents of the current perspective that is being deployed by the Fed would argue, well, things are much better than was previously the case, and economists would have expected a much deeper slowdown, if not a recession, with this level of rates. But the two things bail this out. Firstly, the fact that companies in the US were not firing people. There was an expectation of a meaningful spike in unemployment, and given how difficult it was to find labor force over the recent years, many companies decided, we're not going to make layoffs. We're going to hold on to our employees even at the expense of our margins, because finding new people to join is just so difficult. Like job openings data was actually quite telling in that respect. So one part of the argument is that this time is a bit different because employers were so keen to keep their staff on board. And the other aspect is, when so many people refinance their mortgages, when your mortgages were at whatever 3.5%, 4%, those people are not feeling the pain. Like the pain is felt more in the lower income groups where you have exposure to credit cards, auto loans. But when you're looking at the actual data, what's been driving the resiliency of US economy over the recent few years has been the spending of the middle class and more wealthy consumers. And those refinance when the rates were really low. So you have those two special factors that significantly increase resiliency of the US in the face of this higher rate regime, which might mean that you don't need to change the paradigm, but we're clearly going to see more debate within the Fed. We're clearly going to see more incoming data whether inflation normalizes and allows the Fed to cut more aggressively next year. And in our opinion, inflation is likely to settle quite a bit above the 2% that Fed is hoping for, which means that whereas in the past you could see 10-year treasuries at 1.5% yield, something like that, this is less likely to happen over the coming years. So in our opinion, yields will be coming down, but it's not outside of the realm of possible that you just settle around 3.5% for 10-year treasuries, and you don't go any further than that. So this is probably the most important debate for fixed income investors over the quarters to come, where that neutral rate is, where's the rate where the economy doesn't get better or worse and can tolerate it relatively easily, because right now there is no agreement whatsoever about what that level would be.
Thanks for explaining that. So 3 to 3.5, that's kind of the range for the 10-year that you're looking at. What about the Fed funds rate? I actually, I don't know what the terminal rate is now, because the data has probably changed that a lot. But where do you think is the lowest rate on the Fed funds cycle?
Right now, market is pricing around 100 basis points this year, more than 100 basis points cuts next year. And we think it's perfectly plausible that Fed normalizes to anywhere between that 2-3% kind of range and settles there. But there is a risk that inflation remains stickier, that their ability or willingness to cut aggressively will be diminished. And we had that cycle back in the 90s, way before I was doing what I'm doing right now, when all the Fed was able to do is to cut rates by about 100 basis points, and then another rate hike ensued after that. So we will monitor whether there is an ability for the Fed to go more aggressively or not. And all those questions about where the neutral rate is, where the 10-year will trade, where the Fed funds will be are intertwined. And we will just watch data accordingly, whether indeed we're following the classic path of pretty aggressive rate cuts over the coming year, which would be a great boon to fixed income investors, or we need to settle for less over the coming years, which at the end of the day is not the end of the world, because in that environment, are you going to complain about getting paid 5-10% kind of returns within fixed income on a go-forward basis? Probably not, but that still could have broader implications in terms of people's portfolios, because the fewer rate cuts ahead, the more likely they're probably going to stay in money markets or short duration instruments rather than going further out the curve.
Do you have a view on the yield curve steepening or exiting inversion?
So yeah, we would expect in this cycle for the curve to normalize. But again, it's very much contingent on continued moderation in inflation. If that does not happen, then you have a likely scenario where investors start even worrying about the potential for rate hikes, which would pressure the front end of the curve. And that in return will spur fears of a more pronounced economic slowdown, reducing yields further out the curve and kind of fueling the inversion that we have seen within the markets when you had this balancing act between too high inflation and growth fears at the same time. So our base case suggests that we will normalize and cuts will be coming, but we need to see more incoming data that validates that, because January prints were not the ones that Fed was hoping to see.
The world's leading institutional crypto conference is just a few weeks away. Digital Asset Summit London is running from March 18th to the 20th, and the lineup is absolutely stacked. Danny Masters, Mark Yusko, Dan Tapiero, Michael Howell, Joseph Wang, need I go on? Goldman's going to be there, Citi, JP Morgan, BlackRock, Chainlink, A16Z, Aave, Grayscale, Brevin Howard, Bloomberg, basically everybody. So click the link in the description to see just how packed out our guest list is, and use code FG10 to get 10% off your tickets. Thanks, let's get back to the interview.
Andrzej, one of the most fascinating things you said in this conversation was about the high yield maturity wall. You can explain for the audience that for when credit, most time a company defaults, it's not because they miss an interest payment, it's because they miss the balloon payment at the end, the principal. And so the principal is due, that is the high yield maturity wall. So you're saying that the maturity of high yield is so far out in the future, and probably more so than close to any time in your career. Is that fair to say?
At least for this year, yes. Companies are sleeping soundly knowing that there's barely anything they need to address this year. But as we're moving into 2025, those numbers are picking up. So from the middle of 25 onwards, we are seeing quite an increase in maturities. They're still manageable by historical standards, but something that market will have to address. And in fairness, if issuers were proactive in refinancing 25, 26 maturities, that would be really welcome, because the downside of companies being so busy in 2020 and 2021 is the fact that it's like crickets within primary markets within high yield. So the volumes have declined dramatically compared to those previous years. And this year, they have picked up a bit, but they're still way off the pace of 2020 and 2021. And I bet you a lot of investors would gladly gain exposure to new investment opportunities as companies want to refinance. So if indeed yields start coming down and management teams will be pretty happy locking in more reasonable coupons, we actually could see a pickup in primary activity within high yield that should be welcomed, because that will help to address that maturity wall within 2025 and 2026. So at the end of the day, it's really all about liquidity. If you have access to the market when you need to refinance, great. If you don't have that access and the music stops playing, that creates issues within our universe, and that's where trouble starts. So for now, companies are in very good shape. Leverage is low. They locked in low cost of funding in a high yield bond space, but they can't rest on the laurels forever, because those maturities will be eventually coming in 25 and 26, and you have to do something about that. It's just that in public markets, we have so many more avenues to address that when the time comes than in the private space.
Thanks. So high yield issuance was extremely high in 2020, 2021. It fell off a cliff basically in 2022 as interest rates rose up. You're saying that it's picked up slightly in the month of January, but to the extent that it's still lower than it used to be, it's not because there's a lack of liquidity. In other words, it is an issuer's market. They have control, and if they want to issue it, they can. It's not like investors are unwilling and there's fear in the market. No, investors want to do the deals in high yield. It's just companies don't need the money, pretty much. Is that what you're saying?
That's it. That's exactly the situation. And in a way, that's what also allowed spreads in high yield to be so well behaved in a phase of an economic slowdown, where you just have scarcity of bonds. And that means that, at least from our perspective, there are corners of the market to avoid where things are just too rosy. And there are other corners of the market where you have good investment opportunities. So for an active investor, that's still fine. But from a generic investment perspective, accepting those spreads in 300 range is not what makes people particularly excited when they think about high yield.
Is there anything else on the credit spectrum that you are excited about? I know you like duration. We talked about, owning long-term treasuries that benefit as interest rates decline. But, sounds like you're not, very enthralled with private credit. But any other products?
Away from the corporate credit space, we also would say that there are corners of the securitized market that are looking particularly interesting. Like we've seen a lot of pain, especially in the commercial real estate space. And it's been carnage in the office real estate space, as it's being reminded to us on almost daily basis when you open the press. It always creates opportunities. Dislocation for an active investor, dislocations are amazing, because they create opportunities to buy assets at attractive valuations for the benefit of your clients. And within real estate space, while we are structurally very bearish on the office real estate, like we've seen occupancy rates not recovering almost at all, there are other corners of the commercial real estate, whether that's warehouses, whether that's leisure properties or some multifamily residential properties, where you actually can gain access to good assets at attractive valuations, and they're not exposed to some of the negative secular themes like that in office. So if you are brave enough to wade into a market where people have lost a lot of sleep, and the outlook for some corners of that market remains quite bleak. But if you're brave enough to step in and pick up assets that are less exposed to those most vulnerable themes, but still at pretty attractive valuations, we do see that appeal within across our portfolios. You just have to do a lot of homework, because one property on one side of the street compared to a property on the other side of the street could have completely different future ahead of them. So it's a pretty labor intensive work to select the bad from the good.
Yes, and would those be maybe the riskier tranches of the commercial mortgage-backed security market? Is that what you're referencing?
Rather than, for example, conduits, CMBS conduit market, which is a more traditional way of investing in CMBS, it would be single asset, single borrower market, where you have more clarity over who the issuer is or what type of underlying asset you are considering. Here at Blue Bay, we have a lot of expertise within that space, but we feel that in the conduit space, it's a little bit of a gamble, because you essentially buying instruments with meaningful exposure to office real estate, where you just have to bet that it's not going to be worse than you are estimating in terms of your pricing. And we think investors would find it much easier to pull the trigger on those opportunities where you're completely away from office real estate and have nothing to do with that, and focus on safer areas like warehouses or industrial properties rather than office.
Mm.
That's why the single asset, single borrower market within CMBS is more appealing in our opinion.
How does that market work? Is it originated by the lender, or you buy them from the CMBS? How does I don't know much about that.
So for single asset, single borrower market, they issue debt securities, bonds, as any other CMBS issuer would. They're just not in a conduit format where you have a whole mix of variety of different asset types, but they are tranched, and you can have exposure to different layers of a mezzanine structure depending on your risk tolerance. But that space is definitely less liquid, so those kind of investments you need to be more prepared to hold for longer before you realize your value. But as often is the case, when market dislocation happens, that just creates medium-term opportunities. So in the more liquid markets like corporate credit, you can take advantage of those pretty fast. The market tends to adjust to news pretty efficiently, whereas in areas like CMBS, you might have to buy knowing that it could get worse before it gets better because of the broader sentiment within the space, but you should be money good on the other side of the trade. So for more patient investors, definitely that is something that we like. And also in the context of our US funds, we allocate a smaller portion of those, for example, core plus strategies to that corner of the market to make sure that we're not too outsized given the risks ahead.
What would you say is one of the most common mistakes that fixed income investors make in the market?
Look, I'm a fixed income investor myself, so it's difficult for me to opine how that compares between, say, fixed income versus equities. But what I see on a day-to-day basis is that you do have a lot of herd mentality. So you tend to have investors following a particular theme and everyone jumping on the same bandwagon in a similar fashion as it was pretty much consensus at the beginning of the year that rate cuts would be starting in March and would go as much as 150. So as you can imagine, when we were speaking to our clients, some of them were skeptical of our view that it's too much too fast, and maybe now they wouldn't be saying that. So kind of herd mentality definitely is something we do see a fair amount of. The other issue is disconnect that people make between the short-term catalyst and long-term catalysts. So, for example, you can have a situation where market is processing a specific data release, like today's with inflation data that disappointed, um, and could aggressively trade on the back of that. Where in reality, the key question is what you asked a while ago: is about what does it mean for future rates? What does it mean for how far Fed can cut over the next few years? Because just one data print is just so much less important than a broader direction of travel. And we see way too much focus on kind of short-term noise and not enough debate about like the bigger building blocks within the market. Like there's plenty of investors who debate these issues, but in terms of day-to-day trading activity, it's pretty clear that short-term factors tend to win. And the last issue that is a problem within fixed income broadly, but it's more about the nature of our industry, is that asset managers and debt investors have raised an absolute ton of money since global financial crisis. So the space has ballooned in size. And what happens when you become big and bloated? Well, that means that your ability to maneuver through the markets, your ability to be nimble, your ability to source individual opportunities that make a difference in your portfolio diminishes a lot. You become a beta junkie. That's what we normally call that, where you just have to bet whether things go up or down, or bet on big kind of beta drivers of your portfolio, like investment grade versus high yield, emerging markets versus developed markets, rather than being able to express views on specific issuers, specific companies, specific securities. In our view, the latter focus is much more valuable because our Blue Bay approach has always been that I've got a much better control over those catalysts about working out what could be the drivers of every investment story rather than putting a crystal ball on the table and betting on is the market going to go up or down tomorrow. And the asset class has grown so much and so much money has been poured into our universe that you ended up with a situation when vast majority of players are just too big, too bloated, and unable to reflect those views. And that just then exacerbates the beta moves. We overshoot during the sell-offs and we overshoot during the rallies because everyone is trying to reposition at the same time and cannot be really nimble about it. And that's something that we want to avoid as much as physically possible within our team.
Andrzej, thank you so much for coming on Forward Guidance, sharing your views, and thank you everyone for watching.
Thank you so much, Jack. Such a pleasure to speak to you.
Thanks for watching. Remember to check out vaneck.com/HODLFG to learn more about the VanEck Bitcoin Trust, ticker HODL. A reminder that Forward Guidance episodes are available on all podcast apps and on Twitter, where I post them regularly at JackFarley96. Thanks again. Until next time.